Your traditional IRA could cost your family far more in taxes than you realize unless you take action before it's too late. Every dollar in a traditional IRA carries a future tax obligation, and in many cases that burden falls on the people who inherit your savings, not on you. When your children or other beneficiaries inherit a traditional IRA, the money they withdraw is taxed as ordinary income. If they are in their peak earning years, those withdrawals can push them into higher federal tax brackets, meaning a large portion of your lifetime savings could end up going to the IRS instead of your family. The rules became even tougher after the Secure Act eliminated the Stretch 1RA for most beneficiaries. Instead of spreading withdrawals over a lifetime, most non-spouse heirs must empty the inherited IRA within 10 years. That compressed timeline often forces them to recognize large amounts of taxable income during the highest earning years of their careers, increasing their overall tax bill. Imagine leaving behind a $400,000 IRA. If your child inherits it in their early 50s, they may be required to withdraw and pay taxes on the entire balance before reaching retirement themselves. Those additional withdrawals can push them into significantly higher tax brackets, reducing the value of the inheritance you worked decades to build. Many retirees mistakenly believe this problem only affects wealthy families. It doesn't. Even an $80,000 or $100,000 IRA can generate thousands of dollars in additional taxes for heirs when distributions are required over a 10-year period. The size of the account changes the dollar amount, but it doesn't eliminate the tax issue. Another common misunderstanding is that naming beneficiaries completes the estate planning process. While beneficiary forms determine who receives your IRA, they do nothing to reduce the taxes your heirs will owe. Passing along a traditional IRA without proper planning can leave your loved ones with a substantial tax burden. Fortunately, there are strategies that may help reduce or even eliminate much of this future tax liability. One of the most effective is a carefully planned Roth conversion. By voluntarily paying taxes today at potentially lower rates, you may allow future qualified withdrawals to be tax-free for both you and your beneficiaries. Unfortunately, many retirees never hear about these strategies until it's too late. Some financial advisors focus primarily on managing assets rather than discussing long-term tax planning, leaving families unaware of how inherited IRA rules can affect their legacy. The goal of retirement planning isn't simply to accumulate savings, it's to preserve as much of those savings as possible for yourself and the people you care about. Understanding how inherited IRA rules work and planning ahead can make a significant difference in how much of your hard-earned retirement nest egg ultimately stays with your family instead of being lost to unnecessary taxes. The money wasn't lost because of poor investments or bad market timing. It was lost to a tax system that was completely predictable and one that could have been managed while the original IRA owner was still alive. That's exactly what this video is designed to help you avoid. Over the next few minutes, I'll explain 3 proven strategies that can help reduce the tax burden your family may face after inheriting your IRA. The first strategy is the Roth conversion, the most effective tool available for many retirees, yet also one of the most misunderstood. The second is using qualified charitable distributions, QCDs, to reduce taxable IRA balances while supporting the charities you care about. The third is using life insurance strategically to help offset the taxes your heirs may eventually owe. I'll also cover 2 important bonus topics. First, the Roth conversion ladder, a step-by-step approach that spreads conversions over several years to minimize taxes. Second, a common beneficiary designation mistake that can undermine even the best retirement and estate planning strategies. Everything discussed in this video is based on current federal tax law and existing IRS guidance. Let's begin with the Roth conversion. one of the few strategies that allows you to pay taxes on your own terms instead of leaving that burden to your children. The biggest misconception about Roth conversions is that they're only worthwhile if you expect your own tax rate to be higher in retirement than it was during your working years. While that comparison matters for some people, it misses the most important issue when you're planning for your heirs. The question isn't whether your future tax rate will be higher than your current one. The real question is whether your current tax rate is lower than the tax rate your beneficiaries are likely to face when they inherit your IRA. For many retirees in their 60s and early 70s, the answer is yes. After leaving the workforce, taxable income often drops significantly. Meanwhile, adult children are frequently in their highest earning years when they inherit retirement accounts. If they must withdraw inherited IRA funds during that period, those distributions can be taxed at much higher rates than you would pay today. That's why paying taxes now through a carefully planned Roth conversion can leave your family substantially better off than delaying the tax bill. Here's how a Roth conversion works, in simple terms. Money is transferred from a traditional IRA into a Roth IRA. The amount you convert is added to your taxable income for that year and taxed at your current ordinary income tax rate. After that, the money grows inside the Roth tax-free. As long as the Roth account satisfies the IRS requirements, including the 5-year rule and qualified distribution rules, future withdrawals are generally tax-free. Your beneficiaries are still required to empty an inherited Roth IRA within the 10-year distribution period under current law. However, unlike a traditional IRA, those withdrawals are generally free from federal income tax. That means the timing of their withdrawals no longer creates the same tax problem. Another advantage is flexibility. You don't have to convert your entire IRA in 1 year. Many retirees convert only enough each year to stay within their current tax bracket, avoiding unnecessary taxes while gradually reducing the size of their traditional IRA. If your retirement income comes mainly from Social Security and a modest pension, you may have room to convert part of your IRA each year while remaining in one of the lower federal tax brackets. Locking in a lower tax rate today may save your children from paying considerably higher rates later. Even retirees with larger pensions or investment income can often benefit. Although their available conversion window may be smaller, converting dollars at a 22% or 24% tax rate may still be far more favorable than having heirs pay taxes at 32% or even 37% in the future. For example, converting funds at a 24% tax rate instead of leaving your heirs to pay 37% creates a 13 percentage point tax advantage. On a $300,000 IRA, that difference could preserve tens of thousands of dollars for your family. However, Roth conversions are not without trade-offs. The amount you convert increases your taxable income for that year. It may cause more of your Social Security benefits to become taxable, increase your Medicare IRMAA premiums, or affect other income-based calculations. That's why every conversion should be carefully evaluated to ensure the long-term tax savings outweigh the short-term costs. Here's one practical step you can take today. Pull out your most recent federal tax return and locate your taxable income on Form 1040. Compare that figure with the upper limit of your current federal tax bracket. The difference between those two numbers may represent the amount you can convert this year without moving into the next higher tax bracket. Understanding that number is the first step toward creating a smarter Roth conversion strategy. If you've never calculated your Roth conversion opportunity, now is the time to do it. Contact your tax professional or use the IRS online tax tools to estimate how much you can safely convert without moving into a higher tax bracket. The ideal conversion amount is different for every retiree and can change from year to year as your income changes. That's why this should be reviewed annually, not just once. Now let's move to the second strategy, the Qualified Charitable Distribution, commonly called a QCD. Many retirees assume the tax benefit from charitable giving comes from claiming a deduction on their tax return. In reality, most retirees use the standard deduction, meaning their donations provide little or no additional tax savings. A qualified charitable distribution works differently. Instead of taking money out of your IRA, paying taxes, and then donating it, the funds go directly from your IRA to a qualified charity. Because the money never becomes part of your taxable income, you receive the tax benefit automatically without having to itemize deductions. Once you reach the eligible age, you can transfer up to the annual IRS limit directly from your traditional IRA to one or more qualified charitable organizations. Since the distribution never appears as taxable income, it effectively removes IRA dollars from your account at a 0% income tax rate. For retirees who regularly support their church, local nonprofit, or another qualified charitable organization, this strategy can be extremely valuable. Every dollar given through a QCD is one less dollar that could eventually be inherited by your children and taxed at ordinary income rates under the 10-year inherited IRA rules. QCDs become even more valuable after required minimum distributions begin. Rather than withdrawing your RMD, paying taxes on it, and then making a charitable donation, a qualified charitable distribution can satisfy all or part of your RMD while avoiding federal income tax on the distributed amount. For retirees with modest charitable giving, even a relatively small annual QCD can gradually reduce the size of a traditional IRA over time while lowering the future tax burden for heirs. Those with larger retirement accounts can potentially remove much larger balances over several years. Married couples may each make qualified charitable distributions from their own IRAs, allowing them to reduce taxable retirement assets while supporting the causes they value. However, one important rule cannot be overlooked. The money must be sent directly from your IRA custodian to the qualified charity. If you withdraw the money yourself and later write a personal check, the distribution generally becomes taxable, and you lose the primary tax advantage of a QCD. Fortunately, most IRA custodians have an established process for handling qualified charitable distributions. A quick phone call or online request is usually all that's needed to begin the process. If you're eligible and regularly donate to charity, take action before the end of the tax year. Contact your IRA custodian, request the necessary QCD forms or online instructions, and verify that your chosen organization qualifies under IRS rules. Remember, the tax benefit applies in the year the distribution is completed, not when you decide to make it. Now let's discuss the third strategy, using life insurance to help offset the taxes your heirs may owe on an inherited IRA. Many people think of life insurance and retirement planning as completely separate topics. In reality, they can work together as part of a comprehensive estate plan. If your traditional IRA is too large to convert entirely into a Roth, or if your income makes large Roth conversions impractical, life insurance may provide another way to protect your family's inheritance. The basic concept is straightforward. Death benefits from properly structured life insurance policies are generally received by beneficiaries free from federal income tax. By purchasing a permanent life insurance policy with a death benefit designed to offset the estimated taxes on an inherited IRA, you can provide your heirs with tax-free funds that help replace the value lost to future income taxes. Many retirees use part of their required minimum distributions to pay the insurance premiums. Since RMDs are taxable whether you spend them or not, redirecting a portion of those required withdrawals toward life insurance may help create a much larger tax-free benefit for your family in the future. While this strategy isn't appropriate for everyone, it can be especially useful for retirees with large traditional IRAs, limited Roth conversion opportunities, or estate planning goals that extend beyond simply reducing taxes. As with any major financial decision, it's important to evaluate the costs, health requirements, and long-term benefits before moving forward. Remember, you're going to pay taxes on your required minimum distributions whether you spend the money or not. The real decision is what you do with the after-tax dollars. You can spend them, save them, or use part of them to fund a life insurance policy that may provide your heirs with a tax-free death benefit. For retirees whose RMDs exceed their living expenses, this strategy can be especially appealing. Many people with pension income or other reliable retirement income don't actually need every dollar they're required to withdraw from their IRA. Instead of letting those extra funds sit in a taxable account, they may choose to redirect a portion of the after-tax proceeds toward permanent life insurance. Over time, that can convert taxable retirement income into a tax-free benefit for the next generation. For retirees with larger traditional IRAs, life insurance can also help address a problem that Roth conversions alone may not solve. If there isn't enough time or enough room within your tax brackets to convert the entire IRA before death, a life insurance policy can be designed to help offset the taxes your beneficiaries may eventually owe. Consider a retiree with a $500,000 traditional IRA. If an heir inherits that account while already in a high tax bracket, a significant portion of the distributions could ultimately be lost to federal income taxes. A life insurance policy with a death benefit roughly equal to the expected tax liability can help replace those lost dollars. Your heirs would still pay taxes on the inherited IRA withdrawals, but the insurance proceeds could help restore much of the value that taxation reduced. Of course, this strategy isn't perfect. Life insurance premiums are generally not tax-deductible, and the policy must remain active throughout your lifetime. Missing premium payments or allowing the policy to lapse could eliminate the intended benefit altogether. Health also plays an important role. As people age, premiums rise, and certain medical conditions can make coverage more expensive or even unavailable. That's why this strategy is often most practical for retirees in their late 60s or early 70s, when coverage is typically more affordable. If you'd like to explore this option, ask an independent insurance professional, not someone limited to a single company, to prepare an illustration for a permanent life insurance policy. Use an annual premium that matches the amount of your after-tax RMD surplus, then compare the projected death benefit with the estimated taxes your heirs could owe on your traditional IRA.